Welcome to today's accounting lesson. My name is P. Zinzombe, Paddington Zinzombe. I do have my colleagues with me here who is going to take over when I leave. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sci-Bono Discovery Center, and it is being broadcast to you by Pakama Research and Development. Our topic for today is still on tangible assets. We are still going to be looking into tangible assets. Today, my colleague is going to take it a little bit further and look into how these tangible assets fit into our financial statements. So it's going to be tangible assets and then financial assets as we go. Now, the objectives of this lesson is to focus on the disposal of tangible assets. And then we are also going to look into the formats of financial statements and then bring in a little bit of year-end adjustments and then the preparation of the financial statements. Now it's going to be looking into the introductory part of the statement of comprehensive income, which we refer to as the income statement, and then the statement of financial position, which is our balance sheet. Now, back to disposal of tangible assets. Remember, we always say in definition, tangible assets are those assets that the business purchase for use. And please underline, not for the purpose of resale. So they are for use and not to be resold. But please take these assets, at some point, the business may no longer be in need of them. And when that time comes, what is it that we can do with these assets? So, though fixed assets are bought for use by the business, at some point we need to get rid of them. And then we are going to call it disposal of tangible assets. So, in the normal running of the business, we are using them to generate income, but not selling them. But at the end of their life, or maybe when their usefulness is no longer what we wanted, then we are going to dispose them. Now, please take note. There are a number of methods of getting rid of the assets, of disposing the assets. So I'm going to go through these and you can be in a position to look into them. Now, the assets can be sold for cash. So we are going to receive cash for the sale of assets. And please take note, when that happens, what account is affected? We affect our bank account, and then we are going to receive cash for the sale of the asset. Now, an asset can also be sold on credit. Now, when selling on credit, it means we are selling it and giving it away to someone with just a promise that the person is going to pay us in future. So we are creating a debtor. So the account affected becomes debtor's control. When assets are sold on credit, debtor's control is affected. Assets can be donated. We have seen a number of times where big organizations donate these assets to other non-profit making organizations because they are no longer useful to the big organization, but they can still be very useful to other organizations. So in this case, we are going to have the account affected being donations. So when assets are donated, it affects donations. And then assets can be taken by the owner of the business, or one of the owners of the business, where a business is having more than one owners, can decide to take over an asset for personal use. And in this case now, the account affected is drawings. Assets can also be traded in. Trade in is where you are giving away the asset in exchange for another asset. So you are having an old model of an asset and then you are exchanging it for a newer model. And in that case, usually the one who is giving you the newer model may ask you to add on the amount, on the value of the asset. So in that case, we are having to give away. And in that case, the account affected becomes the creditor's control. An asset can just be scraped off. When we are scraping off, we are writing it off. It's no longer useful to us, and we are not in a position to sell it to anyone or to donate it to anyone or even to give it over to the owner of the business. In that case, we are just going to write off because there is no payment or an exchange that we are going to get for this asset. And then assets can also be written off because of damages. In that case now, that's when we go to our insurer and we are expecting the insurance company to give us something in return for the asset that have been written off. And in that, usually what happens is the insurance company is going to honor our claim and promise us that we are going to get a certain amount of money. So it is going to be a accrued income affected in that case. So please take note. When we dispose in one way, there is an account, a particular account that is affected by that. Now let's look into the format of our asset disposal account. This is one of the easiest accounts that you can be expected to prepare. Look into it. Now we are just going to have our account as usual with a debit and credit side. Now there is the name of the account, the asset disposal account. Now what you are supposed to do is on the date of disposal, you are supposed to transfer the asset from the asset class of the account into the asset disposal account. So this can be either equipment or it can be vehicles. So we are going to credit the equipment account or the vehicles account, and then we are going to debit the asset disposal account. When that happens, we are using the cost price of the asset. So we are transferring the cost from equipment or vehicles into the asset disposal account. So please take note, this figure is always the cost of the asset. And then we now get to the credit side of the asset disposal account. We are supposed to indicate now the total value lost by the asset to date, to the date of disposal. The total value lost, and we call that accumulated depreciation. So we are going to credit with the total or the accumulated depreciation. Now, please take note, this we are interested in the figure on the date of disposal. On the date of disposal. We are not interested in the accumulated depreciation on any other day except on the date of disposal. Very important. Now, after that, we are going to credit the asset disposal account indicating how we are disposing the asset. Remember, if it's for cash, bank is affected. If we are disposing on credit, debtors control is affected. If we are donating the asset, donations is affected. So here we are going to indicate how we are disposing the asset. Please take note. How are we disposing the asset? So we are going to say if we are selling it for cash for 20,000, then it means 20,000 appears here. If we are donating at the value that we are attaching to that asset on the date of donation is 20,000, it appears there. 3 entries made now. The cost price on the debit side, accumulated depreciation on your credit side, as well as the disposal value on the credit side. Now you need to balance it off. Now let's assume the cost price is the total of the cost price is more than the total of these two figures, which are accumulated depreciation and bank. So if the total of the cost is more than the total of these values, it means now we are going to be having a loss on the sale of the asset. So this figure is going to be a balancing figure. a balancing figure, a figure that makes sure that the two sides are equal. That makes sure the two sides are equal. Now, let's assume it happens that the credit side values are giving us a bigger total than the cost. Then it means the balance will move to the debit side, and in that case, it is no longer going to be a loss, but it becomes profit on sale. It becomes profit on sale. So the balancing figure can be either on the debit side as a profit on sale or on the credit side as the loss on sale of an asset. Please take note that notation that is on your screen at the bottom. Profit on sale of an asset is recorded on the debit side of the asset disposal account, which means the loss goes on to the opposite side. Please take note of the format. Now, when do we sell our tangible asset? Do we just buy our tangible asset and then we look at it and we admire it and then we decide to dispose it? No. Now, disposal of tangible assets takes place at 3 critical times in a year. It can take place at the end of the year. At the end of the year. Now, what does that mean? It means the calculation of depreciation for the year is already done and it's added onto the previous accumulated depreciation. Now we are having our total accumulated depreciation on the date of disposal. Disposal can be done when the year is starting. In that case, we are not going to trouble ourselves with anything because depreciation have already been calculated and our accumulated depreciation is already in place. So there is no adjusting to the accumulated depreciation. That becomes the accumulated depreciation on the date of disposal. Or sometimes disposal of assets takes place during the year. Now, when that takes place during the year, we need to adjust our accumulated depreciation because the last figure for accumulated depreciation that we are having is when the previous year ended, which becomes at the beginning of the year. Now, what happens? We need now to add depreciation from the beginning of the year to the date of disposal. Please take note that period. We should not forget that period. We should always calculate that depreciation so that we can have the accumulated depreciation on the date of disposal. Very important. Accumulated depreciation on the date of disposal. So assets are disposed at carrying value, or they can be disposed at a profit or at a loss. When we are disposing assets at the carrying value, it means we are not going to have any profit or loss on the sale of that asset or on the disposal of that asset. But if we are disposing it at more than the carrying value, it means we are gaining something. We are disposing it at a profit. When we are disposing it for less than its carrying value, it means we are losing out. We are losing out as a business. So it means we say we are disposing it at a loss. Class of 2022, please check this. We are now going to look into the real preparation of the disposal account. And please take note, in so doing, we are also going to be looking into the adjustment of our accumulated depreciation so that it is the correct one on the date of disposal. And make sure this information fits into what we are having. Now, the information provided here says the financial year of BBB Traders ends on 28 February 2021. The following balances appeared on 1 March 2020. Please take note of those two dates. What's so special about the two dates? The other date marks the start of the year and the other one marks the end of the year. So our year started on 1 March 2020 and it going on until 28 February 2021. So the balances that we are given are on 1 March 2020, which is at the start of the year. Now, what was the value for our vehicles? It was 312,000. And then the accumulated depreciation on vehicles, 104,000. Now, something happened during the year. Now, it's saying here on 31 August, look at plus 31 August during the year. So let's check here. The year started. The year went on until the end. So this is your March 2020. And this is your February 2021. And somewhere during the year, something is happening. And it is in August. In August, they decided something about a vehicle. So they're saying on 31 August 2020, BBB Traders sold an old vehicle to Z Traders for 47,200 on credit. Please take note, on credit. And we said when it's on credit, this is our creditors' control being affected. This vehicle originally cost 76,000. The total amount of depreciation at the beginning of the year amounted to 34,000. Very important. This is the cost of the asset. And remember, cost is what we paid to acquire the asset. It is not going to be changing. And then, at the beginning of the year, when the year started, the accumulated depreciation was at 34,200. Now, are we disposing this asset at the beginning of the year? No. We are disposing it during the year. It means it creates a gap between the start of the year and the date of disposal in terms of depreciation, which means it changes our accumulated depreciation. Now, they are also saying on bulletin number 2, on 1 December 2020, which is still during this year, somewhere after August, a new vehicle was bought for cash, 200,000, and the funds were transferred electronically to the motor dealer. So it means now we are also buying a new vehicle. Usually when we dispose our vehicle, it's because it is no longer doing what we want, but usually we also replace it. Please take note. Depreciation is going to be calculated at 20% per annum on the diminishing balance method. Remember, when we are busy with our asset disposal, we should also be mindful that we need to calculate depreciation for the remaining assets that have not been sold, because only a vehicle worth 76,000 is being sold. It means from 312 we still have other remaining vehicles. And then we also have to calculate on the new one. Let's deal with asset disposal to start with. On 31 August 2020, BBB Traders sold an old vehicle to Z Traders on credit. 47,200 is the amount that we are expecting to get. It have originally cost 76,000 and depreciation at the beginning of the year is 34,200. Now, our first step is to calculate depreciation because we want to adjust the accumulated depreciation. The one that we are given is what we had at the start of the year. But remember, like our age, accumulated depreciation is always going up. It's always increasing. So we need to calculate depreciation for the period that we are having from 1 March until August 2020. Now, 20% per annum. How do we go about it? We are using the diminishing balance method. The diminishing balance method is referred to as the carrying value method. So the first thing that we need to calculate is the carrying value of that asset before we can think of disposing it. 76,000 is the cost. The accumulated depreciation was at 34,200, which therefore means we can easily calculate the carrying value. Let's do it, boys and girls, my class of 2020. We are going to end up getting 41,800 as the carrying value. Now let's use it to calculate our depreciation. Remember, we need the value, we need the rate, and we need a period. How long is it from March to August? March, April, May, June, July, and August. 6 months. So it's going to be times 6/12. And then we get our depreciation of 4,180. Now, are we done? We need now to take this information that we now have into our asset disposal account. Remember, on the debit side, that's where we start. We are transferring the cost of the vehicle into the asset disposal account. On the date of disposal, please check note of the date. What are we disposing? A vehicle. What is the cost of the vehicle? 76,000. And then we move over to the credit side. We want the accumulated depreciation. We want the accumulated depreciation. But remember what they had given us at the beginning. They had given us 34,200, and we said this was accumulated at the start of the year. But we need accumulated on the date of disposal. So we add the depreciation of 4,180. 34,200 plus 4,180, and it gives us 38,380. Now, we are having these two. Now, remember, we have got to dispose it now. And they said we are disposing it on credit. What does that mean? It means now debtors control is affected. And at how much? The figure given is 47,200. When those three figures or those three entries are in the asset disposal account, we are nearly done. What's left? To balance it off. When you're balancing it off, you are just checking which side is bigger. In this case, my credit side is bigger than the debit side because I only have got 76, and on this side I'm having a total of 85,580. So it means I am going to use this same figure, the total, as my balancing total. That's my total. And then in this case, I say 85,500 minus 76. How much is missing for me to get to 85,580 when I'm only having 76,000? And then the balancing figure is 9,580. Please take note. Because it is coming to the debit side of the account, it is going to be profit. But if it was going to be on the credit side, it was going to be loss on sale. Now, this information, we need to take it now to the final accounts. Where do we take it to if we are to prepare our final account? Please take note. There is going to be two areas. We found a profit on sale of an asset. This becomes income, so it goes under operating income. This is an income item we gained when we sold our asset. But at the same time, the item of depreciation for this period, the item of depreciation which took place during this year, it's going to be taken under operating expenses as depreciation. And please take note, this is not the only depreciation figure that we have. We are still going to calculate depreciation on the remaining assets, as well as calculate depreciation on the new asset, remaining vehicles and the new asset. Now, How do we record this in our tangible asset note? Remember, the tangible asset note is divided into three very important parts. I always talk of these three very important parts. Now, which parts are these? The first part represents the start of the year, the beginning of the year. This one represents what happens during the year. And then this one represents the end of the year. So at the beginning of the year, we are having the cost of the asset and the accumulated depreciation of the asset. So we can easily find the carrying value of the asset. Remember how it goes? Cost minus accumulated depreciation gives us carrying value. Now, when we get to the movements which is taking place during the year, remember we have got additions, we have got an item of disposal as well as depreciation. Now, please check, where are we interested in? The disposal of assets part. So we record disposal at carrying value. Please take note of that. Disposal at carrying value. So it's going to be the carrying value figure that we have, which is always found by saying cost minus accumulated depreciation. So that's why you can see the only figure that appears there is the carrying value amount of 37,620. But please take note, depreciation also needs to go there, but not only as the only item that we used when we dealt with asset disposal, but combined with the other two figures that we have. Take note how this affects our tangible asset note. Now, let's look into the depreciation of the remaining assets. Let's start with the new one. The new one is easy. Just remember this, boys and girls. We calculate depreciation on an asset for the period in which we are having it in the business. So if this asset was bought on 1 December 2020, we are only having this asset in the business from December, January, and February. That marks 3 months. I know you have been dealing with this item of depreciation for some time. Now it's just going to be straightforward. 200,000, which is the cost of the asset. Remember, though we are using the diminishing balance method, when an asset is still new, it have not yet been depreciated. So the carrying value is still equal to the cost. So our carrying value for that asset is 200,000, the same as the cost. And then 20% of that for 3 months. Remember, December, January, and February is only 3 months. So our depreciation for that becomes 10,000. And then let's move on to the remaining asset. This is where we need to be able to check what's happening. Let's be careful when we are dealing with depreciation on the remaining asset. Please take note. Remember, the cost is 312. But after disposing an asset, is it still going to remain 312? The answer to that is no. So remember, we are supposed to subtract the 76,000 here. Please take note. We subtract the 76,000. What are we doing? We are having a new cost. We are having a new cost. That is not the figure that we are going to use to calculate depreciation because we are not using the cost price method. And then, the minute we dispose of the cost of the asset, we must also remember to dispose of the accumulated depreciation of the same asset. We must dispose of the accumulated depreciation of the same asset. Please take note, I'm using a wrong figure here. 34,200 is the correct one. What are we having here? We are having an accumulated depreciation. Which one? At the beginning of the year. But are we going to use that figure? No. we are now having a cost and accumulated depreciation, which can help us to find a carrying value. Please take note. Now see how it is going to be presented to you. The cost of 312,000 minus 76,000. What are we taking away? The cost of the disposed asset. To have the cost of the remaining asset, which is going to be 236,000. We go to the accumulated depreciation that we had, which is 104,000 minus the accumulated depreciation of the asset that have been disposed, which we had at the beginning of the year, and it's going to remain with the accumulated depreciation of the remaining assets of 69,800. Now, having done this now, we can now use the cost minus accumulated depreciation to get us our carrying value. This is the carrying value of the remaining asset. This is the carrying value of the remaining asset. Please take note. Whenever we are doing all this process, we are interested in this figure, the carrying value of the remaining asset, which is 166,200. Please take note. That is what we are going to use now to calculate our depreciation of the remaining assets. Now, how do we go about it now? We are now going to say 166,200 times the rate, still at 20%. And please take note, this is for the whole year because the remaining assets are not going anywhere for the rest of the year. So times 12 over 12, which is giving us 1. And then we get the depreciation figure of 33,240. So you are going to see that when we are taking this information now to our income statement, it is going to comprise of 3 figures. The depreciation that we had for the asset that have been disposed, plus the depreciation that we had for the new vehicle, plus the depreciation that we are having for the remaining vehicles. 3 figures to take care of. The depreciation on the asset that have been disposed, plus depreciation on the new asset and depreciation on the remaining vehicle. So you are going to see that when it comes to total depreciation, it is going to be our 33,240 plus our 10,000 plus our first figure that we had for our depreciation on the vehicle that have been disposed. That put together is going to give us the total depreciation that we are looking for. Please take note. That's how, and that's the figure that you are going to take to the income statement as depreciation. And remember, the same figure is also going to be taken into the note, the tangible asset note, which is note number 3, as depreciation. Boys and girls, hope this activity is making sense to you and it is going to help you in order to be in a position to do better when it comes to disposal of assets. Now, I am going to hand over to my colleague who is going to be coming in to continue with this presentation. Until we meet again, please enjoy this lesson and please stay tuned.
Good day, grade 12 learners. Welcome to today's accounting lesson. My name is Hector Sibusiso Nkosi. This lesson is brought to you by Gauteng Department of Education in collaboration with Sci-Bono Discovery Center and broadcast by Pakama Research and Development. Grade 12s, today we'll be looking at the year-end adjustments. Basically, we'll be looking at your financial statements. Now, in grade 11 and grade 10, you were introduced to 2 sets of financial statements. That was your income statement and your balance sheet. Now we're going to look at those. In grade 10, you have already been introduced to the financial statements of a sole trader, namely the income statement. Grade 12's income statement, it can also be called as a statement of comprehensive income. So in this statement, that's where we put or we disclose everything that is an income or an expense. And remember, in your income statement, all the expenses must be subtracted and all your income must be added. Then another set of your financial statement, it is your statement of financial position, of which it can be called a balance sheet. Basically, the statement of financial position, it tells you the position of any assets, equity and liability. No wonder if you still remember when we introduced this statement to you in grade 10, the heading used to be ABC Traders Asset. The word asset, meaning that at that point in time, how much are your assets, how much are your equity, and how much are your liabilities. Whereas the income statement used to be for the year ended. Right. Now let us look at the definitions when it comes to financial statements. I've touched base a little bit on these statements. However, I just want us to look at these statements into detail. Let us start with the income statement, of which, remember, it can be called the statement of comprehensive income. It is the financial statement that shows the income and expenditure. Very important. You must show income and expenditure of the business. It indicates whether the business has made any profit or a loss during the financial period. We know at this point, grade 12s, that when we talk about the financial period, we are actually talking about the full 12 months. Then your balance sheet now, it is the financial statement that it is usually prepared at the end of the accounting period. It shows the financial position of the business in terms of assets, liabilities, and equity. Now, grade 12s, I want us to look at the format when it comes to the financial statements. It is very important for you to know your format. It is easy to know your format. Remember, I always emphasize this. In order for you to be strong with your format, you have to do it on a daily basis. Remember, if you do everything every day, you're just going to be familiar with it. Now, I'm going to take you through to the income statement format. So this is the format for the income statement. Remember, the top part must be the heading, very important. And remember, for the income statement, it is for the year ended. And remember, grade 12s, the income statement can also be called the statement of comprehensive income. Now, the first line item in your income statement, you're going to start with your sales. Remember, your sales, it's an income. Where do you get them? You get your sales under your nominal account section from your trial balance. Then you've got cost of sales. Cost of sales, basically, what it costed you to buy those goods. So basically, cost of sales is an expense. And remember, what did I say to you? I said all the expenses in your income statement must be subtracted, regardless whether they are in separate places, but all the expenses must be bracketed. Please, grade 12s, I'm begging you. You must be able to remember how to subtract your expenses. Then remember, sales less cost of sales, you get your gross profit. Now, your gross profit is when you take your sales and minus your cost of sales. Then now, next, you've got your other operating income. Now, with your other operating income, you must list all the income that are related to the business. Now, grade 12s, please don't forget, all the income, it must be other operating income. I know some of you might put your interest income. Please, the interest income has its own space at the bottom of your income statement. The interest income cannot be included under operating income. So under other operating income, we put stuff like rent income, the profit on sale of an asset. Now I want to pause when I get to this one. Which said not so long ago, under session 1, you did asset disposal. And said taught you on how to account when you sell an asset. And remember, if you sell an asset, you can either make a loss or a profit. And which say you went through the asset disposal T account. Don't forget, grade 12, if you've got a question that incorporates fixed assets, don't forget to calculate when you are calculating your depreciation. Just check if you have sold the asset. Just check if you are making any profit or any loss. Remember, the loss, to say the profit, it's actually the income. The loss, it's actually an expense. So here you've got the profit on sale of an asset, of which is an income. Then you've got discount received, and also you've got the provision for bad debts adjustment. Now, the provision for bad debts adjustment, I'm still going to explain it when I do the year-end adjustments later on. So remember also, the provision for bad debts adjustment, it can be either be an expense or an income, but I'm still going to show you when it's an income and when it's an expense. Then after, you must take your gross profit, add with your other operating income, then you get your gross operating income. Now, let us look at the operating expenses. Remember I said to you, all expenses are subtracted in your income statement, regardless where they're being placed. We saw with the cost of sales, it was placed there on top. For the fact that it's an expense, it's the cost of the business. Therefore, it needs to be subtracted. You will see also later on, with your interest expense, it still needs to be subtracted because it is an expense. So all expenses are subtracted in your income statement, regardless where they are being placed. Now, let us look at your operating expenses. In your operating expenses, you must list all your expenses, all the operating expenses. You must list them, then box them, then you can only subtract your operating expenses. We've got an example, number one, like trading stock deficit. I'm still going to explain the difference between a trading stock deficit and a trading stock surplus. We know that if it's a surplus, it's an income, and if it's a deficit, it's an expense, but I'm still going to do that into detail. We've got the loss on sale of an asset. This is still fresh for you, grade 12s, because now I did it not so long ago. Remember, if it's a loss, right, it's going to be an expense. If it is a profit, it's going to be an income. And remember, you can calculate your loss or your profit in two ways. It's either you can open your asset disposal, or you can do it easy by comparing your carrying value and your selling price. Then you've got salaries and wages. You've got pension fund contribution. Please, not deduction, but contribution. A contribution is an expense because who contributes towards your package? It is your employer. Then you also have medical aid contribution. Then you've got packing materials. When you speak of packing materials, basically, guys, please here you must always record the used packing materials. Remember, packing materials, it's part of your consumable stores. But in your income statement, you must record the used ones, not the on hand. The on hand, they need to be disclosed in your note number 4. Then you've got bad debts. Please also for bad debts, guys, you must know the difference between the bad debts and the bad debt recovered. Remember, the recovered, it's when the debtor now is coming back to pay off the amount that they were owing previously. And the recovered now goes under other operating income. But the bad debts on its own, it's part of an expense. Then you've got all your expenses. Don't forget to take your gross operating income less your operating expenses. You will then get the operating profit. Then that's where note number 1 will start, of which is the interest income. Remember, interest income, it is an umbrella account. Under interest income, you get all these types of interest, such as interest on overdue debtors, interest on fixed deposit. Then, after getting your interest income, you must add your interest income with your operating profit. Then you'll get the profit before the interest expense. Then after, you must further subtract the interest expense, of which is disclosed in note number 2. Now also interest expense, it's an umbrella account. Under interest expense, you've got your interest on loan. You name them, you know them by now, grade 12s, right? And now, remember when I said initially, all expenses must be subtracted in the income statement, regardless where they're being placed. Look now, interest expense, it is an expense. And can you see, you've got a bracket. So now, normally, how do I make learners to understand the format of the income statement? Especially now you are in grade 12. And the problem, or the biggest problem, is the brackets. You find outside that some of the learners, they know how to do their income statement. But guess what? They always forget to put the bracket. Now, you always need to know this, that when you do an income statement, let's say you are in an exam, you get your answer book and they said you must do the income statement. Just remember that it always has 4 brackets. The first bracket is for cost of sale. The second bracket, it is for operating expense. The third bracket, it's for interest expense. And the fourth bracket is the one that is new into grade 12. It's the income tax. Now, I'm sure some of you have already started with companies, but that's a story for another day. Now, let us look at the format for the balance sheet. Now, remember I said a balance sheet. No wonder we call it a financial position. It gives you a position of that asset, of that equity component, of that liability. No wonder the ending always says as at, meaning at that point in time, your assets, they're worth how much? Now, let us look at the top part of our balance sheet. The top part of our balance sheet is actually an asset. We know that we've got 2 types of assets. We've got non-current assets and current assets. And non-current assets are those type of assets that can last us for more than 12 months, whereas the current ones are the ones that can last us for less than a year. Right. Now, under non-current assets, we've got tangible assets, of which you have already dealt with tangible asset. That's your note number 3, and you did that with SE not so long ago. Then you've got financial assets, of which here you've got fixed deposit. But now, you must always remember when you are dealing with financial assets, especially the fixed deposit or the investments, you must always be careful. Because, remember I said non-current assets are those type of assets that can last you for more than a year, for more than 12 months. Now, sometimes you can have an investment that is less than 12 months. Therefore, can you see that it cannot be a non-current asset? Therefore, by default, it will be a current asset because we know that anything that is less than 12 months should be current. Then you add those 2 and box and you get your figure for current assets. Remember, for fixed assets, this is coming straight from note number 3. Then moving on to current assets. Now, when it comes to current assets, grade 12s, normally I always say, remember ITC, inventory, trading stock, trade and other receivables, and your cash and cash equivalents. That's where you get your ITC. Now, look at your ITC. You are starting with your note number 4, of which is your inventory note. Remember here, we disclose what? The stock on hand and any other consumable stores on hand on your note 4. This is an easiest note ever. Then, grade 12s, you've got trade and other receivables. That's where you disclose all your debtors. That's where you disclose all your provision for bad debts. Not adjustment. Remember, the adjustment goes to the income statement. The provision for bad debts on its own comes to trade and other receivables. And we also have your prepaid expense and your accrued income. Also, we have cash and cash equivalents. That's where we get our bank, we get our investment that is less than 12 months. It comes to your cash and cash equivalents, right? You've got your petty cash, you've got your cash float, and so forth. Then after, you must box everything and have current assets. You must add them with your non-current assets. Then you'll get your total assets or the value of the total assets. Now, Moving to the second section of the balance sheet. So now, I'm not going to spend so much time on this one because now we are in grade 12. But I'm going to show you on my next presentation or next slide on how these equities differ. But if you can still recall or remember, in grade 11, we're dealing with partnerships and their equity component was different because it was partnerships. We had capital account and current accounts account. And we're going to look at that in our next slide. And don't forget, you add these two equities and then you'll get your capital equity. Then we are moving to our third component, of which is liabilities. Now, also liabilities is the same treatment as assets. Liabilities are divided into two components, non-current liabilities and current liabilities. Under non-current liabilities, normally we've got a mortgage loan or whatever loan that the business took, right? Then that's where you disclose it. Remember, the loan does not have any note. Then we've got our current liabilities. That's where we get trade and other payables. That's where we get creditors control. We get deferred income, or it can be called income received in advance, right? We also get the accrued expense. Then we also have the bank overdraft under current liabilities. Now, grade 12s, it's very important. You'll never, ever include your bank overdraft as part as your trade and other payables. It must always be shown separately. Yes, your short-term loan, you can include as part of trade and other payables, but bank overdraft must be disclosed separately under current liabilities. Now, grade 12s, this is your final balance sheet. Then after, to get your total equity and liabilities, what do you need to do? Before, you need to say, okay, let me add my equity and my non-current liabilities and my current liabilities. Therefore, you'll get your equity and liabilities. Now, can you see in a nutshell, your balance sheet, it is your accounting equation. Because what did we learn in grade 8 and grade 9 EMS? We said A is equals to OE plus L. So basically, we were doing the accounting equation all along. We were doing the balance sheet all along, but in a form of an accounting equation. Then when we started in grade 10, that's where we introduced the full statement. And yes, now you've got your total assets. These total assets must be the same as when you add your equity and liabilities. Now, grade 12s, let us look at these equity section. As I told you earlier on, that I want to show you the difference between the equity section for each and every form of ownership. Now we're going to start with a sole trader. In grade 10, you dealt with a sole trader and we introduced note number 7 to you. If you still remember, you used to have opening balance, you used to add your profit, you used to subtract if you have decreased the capital or the owner took the capital through drawings, right? And you used to get your total capital. Then in grade 11, we said, okay, what is happening when we've got partnerships? We dealt with partnerships where you've got more than 2 people running the business, right? We introduced 2 equity accounts. We had your capital account. We also had your current account, of which it was note number 8. Now, the capital account, if you can use your logic, it was the same capital account from grade 10. It's just that now we had to do it per partner, if you still remember. Then now we had the current account. Now, with the current account, it was what it was sitting on each partner. Then now we are moving to grade 12, and this is what you'll be learning this year. The equity accounts in grade 12s, you've got your ordinary share capital and your retained income. Remember grade 12s, and I'm sure some of you have already started at school. Now, with the companies, the only way that the company can raise capital is by issuing shares. So to agree with me that now their capital, it should be shares. No wonder we have ordinary share capital. That's where we see how much shares we had at the beginning, How much shares did we decrease through buybacks? How much shares did we add during the year? So can you see it's the same concept as grade 10. It's just that now in grade 12, we're using shares. Then we've got the retained income. The retained income also is the same concept for your current accounts for partnership. Retained income, it's what the company is retaining after paying tax and after paying their shareholders dividends. What they are left with, it is what it is retained. And this is how we'll get our equity components for this year. Now, let us start with our year-end adjustments. Very important. It's very important for you to read always because you don't want to miss anything. Now we're going to look at this example together. It says you are provided with a pre-adjustment trial balance. Remember grade 12s. Pre means before. Balance of Josie Traders, a partnership with Morgan and Wendy as partners. Their financial year ends on 28 February 2021. Very important to know the financial year. Remember, I always say this. If your year end, it's 28 Feb, you always go 1 month further down by the previous year to get your beginning. So after Feb, it's March. So it will be March but the previous year. That will be your beginning of the year. If your year end, it's 30th of June. What comes after June? It's July. So if my year end is 30th of June 2021, the beginning should be the 1st of July 2020. I hope you got that. And remember, the accounting cycle comprises of 12 months. Now, we are required to prepare the income statement and the balance sheet. And I'm sure now you are ready to tackle this because I've just shown you, or I've just taken you through with the format of the 2 sets of the financial statements. Right. Let us look at adjustment number 1. Adjustment number 1, it is a popular adjustment. In fact, all the adjustments that we'll be looking at today, those are your popular adjustments and those are the adjustments that you have to understand them. So with your adjustment number 1, we are given an extract from the trial balance and we are given water and electricity. The amount is 17,600. And the adjustment says to you, water and electricity account for February has not been paid, 1,300. Now, you haven't paid an expense, right? Just pack it. You haven't paid an expense. What do we know about an expense that is still owing? Easy. I can hear you at home. You are already shouting answers. An expense that is still owing, it is actually your accrued expense. Some, they can call it as expense payable. Now, let's see on how we can record this type of a transaction. Now, do you agree with me, grade 12s, that in your income statement, you must show your water and electricity? In the trial balance, it was given as 17,600. Remember, you were given a pre-adjustment trial balance, meaning before adjustments. Now you have to adjust. Remember, there's always a difference between a post-trial balance and a pre, right? In this case, we are given what? A pre. So now we have to adjust because it means before. Right. Then now, what we need to do, we know that this expense is still owing. Therefore, we have to add 1,300. Now, why do we add 1,300 into your water and electricity? Now, I'm going to explain to you firstly, according to the GAAP principle. One of your GAAP principles, of which is the matching concept, says to you, all income and expenses must be recorded within their financial period. Now, we know that we're ending in February, and yet February is still outstanding. Therefore, in order for me to complete my financial period, I need to add the further 1,300. And voila, we've got 18,900 by saying 17,600 plus 1,300. Now, you must always kill 2 birds with 1 stone. Now you have dealt with the income statement effect. Now you must move to the balance sheet effect, or if the examiner asks you notes. Now let us look at the notes. We know that accrued expense can be shown under trade and other payables because it is a liability and you can only show the adjustment, not the 18,900. It should be the adjusted amount. Let us look at adjustment number 2. With the adjustment number 2, we are given also an extract from the trial balance. This one has to do with the fee income. It says to you, a cash customer Mzizi paid 2,800 for installation fees in February, but the job will be done in March 2021. Now, this is easy. Remember, a business can be under a service business or a trading business. In this case, or it can be both. And we can see in this case, because we have another adjustment that has to do with trading stock. So meaning that the business, it's both trading and service business. So they might be selling some stock at the same time, they might be rendering a service to the consumers. Now, as you can see here, they also do the installation fees. Now, I know some of you might be confused. What is this? Basically, this is a fee income because this is an income that we get when we render a service. So now they've already paid us the fee income for March. Now what needs to happen? Remember, we always go back to the basic. Your matching principle says all expenses and income must be recorded within their financial year. We can see that the job will be done in March, but it is for February. Right? It was paid in February. So we've already paid for March, and March is another financial year. So we have to take it out in order to do the matching concept. Now, no wonder we'll take the pre-adjustment of 1,105,000 minus the 2,800, and now this is what needs to go to your income statement. Now, we call this an income that has been received in advance because it's for March, but it has already been received. So it's a liability. We are liable for this 2,800 because the person can claim it at any time and say, look, I need my 2,800 back. Therefore, no wonder it's shown under trade and other payables. Now, some, they call it a deferred income, or you can call it an income received in advance. Don't forget, grade 12s, you must always show the adjusted amount. Not the adjusted amount, this adjustment amount, not the adjusted amount. Because I've seen some of you, they like to put 1,102,000 as trade and other payables. Please, it is what was received in advance, not the adjusted amount. Now, let us look at the last adjustment for today, of which is the adjustment on bank charges, interest on account, and your stop order for insurance. This is an interesting adjustment because bank can either be a favorable or unfavorable, but I'm going to show you shortly. Now we are given an extract also. Bank is given as 66,000, we know. Then we've got bank charges, and we've got interest income, and under this interest income, we've got interest on current accounts. Remember, guys, bank, it is your balance sheet account. Then the rest are your nominal accounts. Then if you look at your adjustment, it says the following appeared in the bank statement of Bank of Africa on the 28th Feb 2021. The information has not yet been entered in the books. Now you've got the bank charges for 2,000, and you've got interest on current accounts for 250, and you've got a stop order for insurance of 2,500. So basically, these, they still need to be recorded. Remember, matching concept, it is not yet been entered in the books. And this is the bank statement for February. And yes, February falls within our financial period. And remember, we get the bank statement on a monthly basis. Now, let us look at the effect for the income statement. If you look at your income statement, do you agree with me, boys and girls, that your bank charge, it is an expense? Since it's an expense, must be disclosed under operating expenses. The opening balance was 28,600. Because now it has not yet been entered, you need to add the 2,000. No wonder it's a plus 2,000. Therefore, you will get your total bank charges for the year. It's 30,600. Then insurance, same concept. You must take your opening of 28,800, add the 2,500, because also the insurance was not yet been recorded. Therefore, you get 31,300. Then, remember, your interest income, it is an income, but it must be shown separately there below in your income statement as interest income. You can't put it as other operating income. Always it must be shown in its own space. Now, your pre-adjustment amount was 1,100. Then you must add a further 250, and your total interest income for the year, it's actually 1,350. Now let us look at the balance sheet effect. Now when you look at the balance sheet effect, now I want you to listen very carefully. Now, if you can go back to your pre-adjustment trial balance, your bank was debited, meaning that it was favorable. Therefore, if the bank is favorable, it will affect cash and cash equivalents. However, the examiner can put bank as a credit balance. If the bank is a credit balance, therefore, it needs to be shown under current liabilities as bank overdraft. Meaning that whatever that affects bank will also affect the bank overdraft. In this case, it was normal is the bank that we know that is favorable. Therefore, it will go to cash and cash equivalents. The opening balance for the bank was 66,000 rands. Then, remember, for bank charges and your insurance, those are the expenses. You pay them. When you pay a bank charge and when you pay for an insurance, what does it do to your bank account? It decreases the value in your bank account. No wonder we subtract 2,000 and we subtract 2,500 for the insurance. Now there's also what? The interest income. Interest income is an income. So it's a gain into your bank account. Money coming in, and no wonder we add the 250 in your bank. And your total bank for the whole 12 months of which is the accounting cycle is 61,750. Please, grade 12s, always check your bank. It can be a credit balance or a debit balance depending on what you are given in that question paper. It might be test, class test, assignment or case study, whatever that you have or you are writing. All right, grade 12s, thank you so much for tuning in today.